$1.65 billion. Let that number sink in for a second. That is the absolutely massive valuation OneSource Specialty Pharma achieved during their recent fundraise in November 2024. So right out of the gate, we're talking about global scale stakes here. Welcome to this explainer. Today, we're going to dive deep and break down the anatomy of a pharmaceutical giant in the making. We are going to unpack their complex corporate restructuring, look at their aggressive growth trajectory, and honestly dig into the underlying financial risks of a rapidly scaling entity that is out to completely dominate a cutthroat global market. Here is our game plan for today. First, we'll cover the OneSource CDMO platform. Second, we'll dive into leadership and capital strategy. Third, the semaglutide growth catalyst. Fourth, we'll navigate the recent financial whiplash. And lastly, we'll break down key risks and liabilities. Let's get right into it.
Okay, Section 1, the OneSource CDMO platform, building the foundation.
Reaching a massive valuation doesn't just happen overnight through organic growth. It's really more like assembling a giant puzzle. It took a highly strategic, multi-entity merger. Step 1 was carving out the CDMO and softgel business from Strides. Then, Step 2 involved extracting the sterile injectables division over at Stericyence. And finally, Step 3, which officially kicked in during April 2024, consolidated these really powerful assets under the OneSource umbrella. The result? A multimodality platform that can produce a staggering 2.4 billion soft gelatin capsules. And that massive foundation is what fuels their global strategy. The key here is their global manufacturing accreditations across their 5 Bengaluru facilities. We're talking the US FDA in the US, the EMA in Europe, the MHRA in the UK, plus Health Canada, Brazil's Anvisa, and Australia's TGA. Why does this matter? Well, in the pharma world, these accreditations are essentially your license to print money in international markets. You literally cannot play at a global scale without these specific stamps of approval. Moving on to Section 2, leadership and capital strategy. Because to understand growth, you have to look at who is steering the ship. To really get a read on where a company's heading, you've got to look at its past. Founder Arun Kumar has an absolute masterstroke of a track record. He's known for acquiring distressed assets, completely turning their operations around, and then monetizing them. For instance, under his leadership, Aguila Specialties was sold to Mylan for $1.6 billion back in FY13. Having that kind of historical win under your belt gives the market a tremendous amount of confidence in your next move. And, as you'd expect, that historical confidence translates directly into cold, hard cash today. A prime example is their massive 801 crore rupee equity raise in FY25 from marquee investors. This is a big deal because it gives them the absolute financial firepower they need to push through intense research, development, and capacity expansions without stalling out. All right, Section 3, the semaglutide growth catalyst. This is where the future revenue story gets really interesting. Before we go further, let's demystify some of this industry alphabet soup. So what's the difference between an MSA and a CSA? MSAs, or Manufacturing Service Agreements, are basically development phase services. They carry a much higher risk of just being discontinued. CSAs, on the other hand, are commercial supply agreements. That is the holy grail: commercial scale, highly visible revenue, and way better profitability. So OneSource's entire growth narrative hinges on successfully transitioning their current MSAs into CSAs as we head into late FY27. Now, why are they so sure they can pull off that transition? Well, the management team summed it up perfectly in their July 2026 call regarding their GLP-1, or semaglutide, platform. They simply said, demand is greater than supply dynamics. The market hunger for these specific treatments is creating a massive tailwind. Essentially, they have a highly sought-after product in a market that literally can't get enough of it right now. But it hasn't all been a straight line to the top. Let's look at Section 4, navigating financial whiplash. The financials have been a bit of a roller coaster. Back in Q3 of FY26, there was a really distinct slump in profitability, and that was mostly driven by delayed Canadian approvals that forced them to defer planned deliveries. But then we see this incredible rebound. By Q1 of FY27, revenue surged to 4,490 million rupees. That is a massive 37% year-over-year jump. And right alongside that, an EBITDA of 1,233 million rupees. It's total financial whiplash, but in a good way, as commercial launches and new contracts finally locked in. Of course, when you see wild financial swings like that, you definitely want some strict assurance.
That's why having an independent auditor's review report by a firm like Deloitte Haskins and Sells on those exact Q1 FY27 results is so vital. It confirms that this massive rebound was independently verified, which adds a really important layer of credibility to the numbers we just went over. Which brings us to our final part, Section 5, Key Risks and Liabilities. We have to shine a light on the shadows behind all this growth.
So let's talk about the elephant in the room. 1,121 crore rupees. That is the size of a massive contingent liability claim from Prestige Biopharma, which is currently pending in a Singapore arbitration center against a OneSource subsidiary. Prestige is claiming they suffered losses due to a terminated contract. Now, OneSource is fighting back to get a refund of their own advances. But make no mistake, any adverse outcome here would put a serious dent in the company's liquidity profile. It is a major pending factor. And that specific lawsuit is really just one part of the broader systemic risks baked into their business model. The CDMO industry is incredibly capital intensive. Just to fund a projected 5x increase in their cartridge capacity, their total debt ballooned to 1,353 crore rupees by December 2025. When you pair that surging capex debt with cutthroat pricing competition from established global players and that ever-present high-stakes regulatory scrutiny from bodies like the US FDA, well, you've got yourself a serious high-wire act. They are balancing massive upfront investments against promises of future commercial success. So all of this brings us to the ultimate billion-dollar question. Can OneSource successfully convert its massive capex investments and development phase MSAs into true commercial dominance, despite the heavy regulatory hurdles and looming liabilities? I mean, they've got the leadership, they have the global accreditations, and the market demand is absolutely there. But execution over the next couple of years is going to dictate everything. It's a fascinating situation, and for sure, one we'll be watching very closely.